Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive right in, take a look, see what's going on today. And if you want to follow me, it's at Finance. And if you want to join our community, finding-value.com, that's where I dive deeper into all these different subject sectors, looking for investment opportunities and sharing those opportunities with everybody in the community. I am not a short-term trader. I am a long-term investor looking for undervalued assets at the bottom of market cycles where you take positions for multiple years. I have averaged, I haven't done the actual math the past year or two. I was averaging 41% per year from 2020 forward. It's probably higher than that because last year I had a really big year. And this year, I think I'm up maybe 20 or 30% is what I'm at this year for year to date. If you want to join, we do have specials. Specials, the coupon code for the monthly membership. It's a 50% discount for the first month only. Ends up being $25 for that first month. And if you join the yearly membership from the monthly, whenever you like, you get a $100 discount using 500YR, and it's 500 bucks for the entire year. I think it's a heck of a special to sign up, and I haven't raised prices since I started this community. Eric Nuttall says there's a historic breakdown between oil inventories and price, and is particularly odd when very high refining margins indicate strong underlying physical demand, excluding China boycott. How to explain incredibly effective presidential jawboning has greatly reduced capital at risk, while desanctioning of Iranian barrels, 140 million barrels, and erratic straight outbounds have led to a temporary oversupply. Ironic given record low inventory levels. Once these barrels get absorbed, we think the 2027 strip will strengthen, with energy equities now discounting $60 WTI. Below the marginal cost of supply, well below historical inventories, price relationship, and at below pre-war levels. We think the setup is compelling, especially for anyone who either felt like they had missed it or are waiting for the war to end. So this is a dot plot. What a dot plot does is it just puts pieces of information on the chart here. That's what that is. So you put your data on the chart. You generally put some sort of line or fit a line to it. That's called linear regression analysis. Then you see how well the dots line up with your potential equation or curve that you put on it. If you look, there's a little arrow way up here where it says this is the current price and inventory level, which is completely off the chart. And what that means is that it's basically an anomaly. When you get these types of dislocations where you plot data over time and then you get these weird one-off pieces of data like we have today, that generally indicates that something is going on behind the background, perhaps. And this is where the manipulation kind of thing comes in because it's like, look, if this is the historical average, and think of it as if inventories decline, the fair value of where oil should be today should perhaps be, let's say, $110 a barrel or something, 105, 110, based off inventory levels, commercial inventory levels as well. Not even the strategic petroleum reserve, which is completely depleted almost. So we see these kind of outliers, and then we try to figure out, well, why? Why do we have this outlier? What is going on? How can we be at the lowest levels of inventory, drawing down ridiculous amounts, and be cheaper than all this time in history? How is that possible? Are they in there manipulating the futures curve? Now, I don't know if they are. My guess is yes. Why would that be my guess? Because we've got an anomaly on the dot plot. And that's it's as simple as that. Another thing that you can look at if you're an investor is you can go and you can look at the ratio of oil to gold. And the gold to oil ratio is at an extreme undervaluation level for oil. So oil is incredibly undervalued. We get these anomalies. Inventories are very low, and all the buffer in the system of strategic petroleum reserves are basically depleted. I mean, if you were to ask me, Andy, how could you manufacture an oil price to three, four, $500 a barrel? They're basically doing it. And the way that you would do that is you would eat through all of your tertiary inventories. What does that mean? It means you eat through your government SPRs around the world. You hold the price down with futures, just like they're doing with this dot plot being where it's at. Suck down all the inventories out of strategic petroleum reserves and through your commercial inventories. Then you are very fragile to a price spike. That is where the conditions are present for a price spike to some ridiculous number. And with oil as cheap as it is today in relationship to gold, from an investor standpoint, there's very little downside risk. So I already took positions in a lot of these oil and gas exploration production companies and energy service companies. I've even bought tertiary stuff around oil and natural gas like coal. I think we are going to have the largest energy crisis and boom in the history of the markets. That's what this is setting up for, and nobody cares. No one cares. But even if my opinion is wrong there, being the largest energy crisis that we've seen, you also have the least amount of downside risk that the market has ever been in terms of a gold to oil relationship, an oil to stocks relationship. It's never been so cheap in relationship to history on a ratio perspective. And we've never had these inventories drain out like that from the strategic petroleum reserve. So we are the most fragile and the most cheap we've ever been in history. Tell me how that isn't a setup. Tell me how in the comments section. Tell me how this is not a good setup. Alfonso de Pablo says the last two times financials traded near current levels relative to the S&P 500 at the great financial crisis lows and the post-COVID lows. The sector went on to become one of the market's leading groups. Take a look at this chart. And this is March 2000, which was a dot-com bubble. We had the 2009 low, 2020, and I do see this kind of squeezing up into this corner here with the false breakdown and a potential slingshot higher for the financials to outperform the S&P 500. The last time we had a big outperformance was during an expansion phase of real estate from 2000 all the way up to 2007 or so. This same thing I think is going to blow to the upside and get a gigantic outperformance. Why do I care about this? People will say, oh, financials. Who cares about financials? No, you should. The financials are tied to money creation. Money creation is tied to the real estate market. The real estate market, or in an expansion phase, is tied to commodities and a weaker dollar. And this is all lining up and is further evidence, if this were to move higher, of that exact market condition that we experienced back here in the last expansion phase of real estate. Now, we are kind of in an expansion phase. We've kind of been trying to go into it this whole time here. And they've been doing this QE weird stuff in the market. But I think this is when we're going to eventually, hopefully, sail to the upside. It says, patience is everything in this market. In today's financial house of mirrors, swinging at every distorted pitch is the fastest way to strike out. Wait for the one that actually looks right. even if the wait feels eternal. Discipline beats activity always. Yeah, I think that's the case, but I don't know what you're waiting for. I don't think there's the distorted pitch is oil. And to take all these swings at it, yeah, but I already took the swing when it was the cheapest in history, which was 2020. And I've been buying along the way. Don't get me wrong. And we are not as cheap as we were back in April, May of 2025, which I think was another critical bottom. But we have another loading point if you'd like to load up in the oil and energy service companies. So there are a bunch of opportunities to continue to buy. So, I- you know, as time has gone on, I don't think it's, I'm trying to think of the right words to describe this, but the things that I've made the most amount of money on, they all have similar characteristics. And the ones that I've lost money on, those companies have similar characteristics. And then to make big amounts of money and the way that you have to act, the way that you have to be disciplined, or I'll call it patience, those are all the same too. It all comes down to buying assets when they're cheap and then riding the big trend, the big bull market, and then doing absolutely nothing the entire time. So you need to load up when the assets are cheap. And even if there's early volatility, that volatility doesn't necessarily matter. It doesn't mean you're wrong. So even if you're down on the position in the beginning and you bought a cheap asset and it gets a little bit cheaper, even if you're down 10, 20, 30%, that doesn't mean you were wrong. Then you hold it when the market condition changes, and you need to be cognizant of those market condition changes. So in 2020, we had negative oil prices, which put the oil to gold ratio the cheapest oil has ever been in history, which means you need to buy as much as you possibly can. Then you just sit and you wait. Oil kind of bounced up in early 2020 and then came back down for kind of like a double bottom in late 2020. So September, October. So even if you purchased in March and April and anywhere around that entire time frame, the best move you could have done, even if you didn't time the bottom perfectly, was to stay long, continue to add in September, October, November of 2020, and then ride the bull market even till today. You should be holding. And that particular mindset in riding of the bull market basically would beat everything in the market. You would have beat all tech, you would have beaten gold, silver, all of the gold and silver mining companies. You would have beaten basically everything. Your returns over that time frame, if you could execute it quite well, could very well be 60, 70, 80% per annum. And I'm not joking. Depending on the companies that you chose. Now, looking backwards, 2020 vision, super easy to look at that. Looking forward, everything is much more difficult. I understand that. But I think what you need to learn is looking backwards, you need to learn all the lessons that you can to implement going forward. And again, what I have found is that it's better to buy when everyone hates something and it's the cheapest and an anomaly in history, and just to hold than to do anything else. That's where you make the most amount of money. There are no strategies in the short term without taking gigantic amounts of risks that can beat that strategy. There are none that I have found. Lobo says, people are asking me what's wrong with uranium. I bought at the beginning of this chart, so you can imagine my answer. More important is that spot always catches up with long-term contracts. Right now, that's bullish. And this is the chart from 2018, just moving higher, 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 and higher. There's nothing to do here. It's in a bull market. So what are my comments here? My comments for most people is that markets are not as fast as you think. Things just don't go straight up. They take time. And the big bull markets, this could last the rest of my life. The rest of my life. And people will be like, well, how come it's not going up? It's like, it is. You're just looking at it from like maybe from this time frame to this time frame. You're looking at it from too short of a time frame. You need to look at these things from a longer time frame and then just you need to act like your life doesn't depend on this asset going up or down in the next week or two. You need to think long term and act short term. Acting short term when the price becomes distorted and take advantage of it. The big long term trend is all intact. There's nothing wrong here. And everybody's like, well, what's wrong with this? How come it's not going up? Guys, I, you're looking at an investor's market with a gambler's mindset. You can't do that. If you're going to gamble, go put it on red and see what the outcome is. It's all based off luck. So is the short term. Short term trading is more based off luck than skill. Long term investing is based off of strategy and skill. Skill being buying undervalued assets and knowing when to buy them and having the emotional fortitude and discipline to execute. Seems like Cabal working awfully hard to discredit oil, gold, silver. It's bullish. You're right. Sit tight. Yes, we're in the bull market. Just sit tight, guys. It's coming. And we're in it. Says, I see the U.S. SPR draws decreased from 9.5 million barrels a week to 5.5 million barrels a week. If demand for crude in the U.S. and from the U.S. remains elevated, as it has been the case till now, commercial inventory draws will accelerate at the same time when Cushing is already at tank bottoms. What do you think that's going to do to price? And if we're already undervalued from that inventory level, we should be trading at 104 to 120. Where do you think the price is going to go? I mean, guys, to me, I can't figure this out. Like, I'm looking at the oil price and I'm staring at this and I'm looking at our commercial inventory levels. And I'm like, well, tell me how how we're not going to have oil prices go up. And people say, well, they're going to go get in there and they're not going to allow it to go up. Well, then we'll just have straight shortages. I mean, massive shortages. Because the longer they hold it down, the worse it gets. So I'm in the camp that they're gonna have to let oil price. I'm in the camp that the market is going to overpower even governments holding this down, and we're going to get a massive spike. That's my guess. Sometime in the future. SPRs are almost done. 4 million barrels per day to 0 million barrels per day in the next couple of weeks. If the Strait of Hormuz doesn't open to replace it, everything goes up, no matter what China does. Now, a lot of people are talking about China. Oh, well, they're going to release their inventory. They're going to release this. It doesn't matter, guys. When our SPR is done, and even if China releases crude, it doesn't matter. We're going higher, in my opinion. I don't know the exact timing of this, but yes. It says, look, it's very simple. Either products are full of crap and the tightness we are seeing in spreads are going to turn to crap, or crude is full of crap and we will reverse violently higher. I'm in the later camp. Now, this demand for products, we have these gigantic crack spreads. Crack spread is the price of gasoline versus the price of crude oil. The spread between those two is your gasoline margins. Your crack spread is what they call it. So what's happening is we're getting gigantic spreads. What this is leading me to believe is that there are futures manipulation in oil because you get these gigantic crack spreads. The crack spread is saying, give me more product, diesel, gasoline, whatever. At the same time, that oil price is low. It's like, how is this possible? Now, is it possible that we have a refining supply constriction? That's possible where supply just runs nonstop, or I mean, the refineries runs nonstop for supply, and oil's actually in a glut. But here's the problem. Where is the oil glut when you look at the inventory level? It doesn't exist. See what I'm saying? So this is where they're coming to the conclusion. They're saying either the crack, the demand on the back end is full of crap, or the oil price is full of crap. The oil price is being manipulated lower, as my guess, through the futures contracts, which Besant and the Japan central bank said that they were going to manipulate. I think they're doing that. They're creating this gigantic crack spread in refining margins in the short term, but we're not building products and commercial inventory of oil, which means the oil price is mispriced, period. That's the opportunity. 100% agree with that. Says the JPY is warning everyone that oil prices are going to snap back up all of a sudden. It cannot tell you when it is going to happen, but it is giving you a pretty good idea of the magnitude of the move. And you can see these are very related. We had this big kind of June mismatch, almost like someone's manipulating the price. Could be. You see what I'm saying? You get all these weird distortions if oil is being manipulated. You get all these distortions across all these different markets. And what they're trying to do is they're trying to use oil to pull down interest rates, I think. Problem is, interest rates are continuing to go up. The market's not falling for it. And I think we're going to see a snapback price in crude oil at some point. I agree with these guys. And again, here's some crazy stuff happening. Today's oil price disconnect is history in the making. To give you an idea of how insane this market is, this is the highest 3-2-1 crack spread relative to Brent price in the history of the oil market. There are distortions building. I am playing this on the oil side because I think that's where the distortion is located. I'm betting against the government, 100%. Now check this out. This is what drives oil demand. Meanwhile, money supply is growing at its fastest pace in 5 years. Guys, I don't know if they're manufacturing something here, like a crisis. To me, I am not sure why you would have this set up, but they're increasing the money supply, the largest increase in 5 years. They're increasing money supply into the largest shortage of oil in the history of mankind. What are we doing here? I mean, seriously, what is this? This is crazy. Guys, this is going to be so inflationary. It's going to be ridiculous. And that's all I've got for today. So we'll end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. I'll be releasing, or I've released a midweek update. So take a look at the midweek update if you guys are interested in how to play some of these ideas and what I think the best opportunities are in the market today. Generally, I'm driven more towards value, just an FYI. So I'll say a lot of my picks that I really like are mainly driven by value. That's what I've got for today, guys. So we'll catch you next time. See ya.